Right now, with our interview of the day with a former Fed official, without question, William Dudley is that. Bloomberg Economics Senior Advisor, the former president of the New York Federal Reserve, and of course, for years with Goldman Sachs. Bill, I thought of you when we saw forward guidance exit stage right today, and I went back to Dudley and McKelvey. What will our world be like without forward guidance?
People are just going to have to parse the economic data a little bit more and think about how that economic data is going to affect how the Fed behaves. I mean, I think Powell made it clear today that they think that they've reached an important point where monetary policy now is broadly neutral, but that doesn't mean that they're going to stop. He also said that policy needs to be made moderately restrictive. And I think the rally that we're seeing today is just a relief rally that happens most of the time when we have these Fed meetings because the risk event is over. You know what's actually happened, and so people can breathe easier, and so people put risk on after the meeting. I didn't really hear his comments as dovish. He kept coming back to the June's summary of economic projections, and if you look at the summary of economic projections, that's ending the year at 3.25 to 3.5%, and with another 50 basis points of tightening in 2023. That's quite a bit more than what's priced into the markets today. So, the fact that he came back to the June SEP projections 3 or 4 times in his remarks suggests to me that the Fed thinks they're going to do quite a bit more than what's priced into markets today.
Bill Dudley, a rude question, which is for market economics, but with your public service, I'll take a chance and ask you, where is your terminal rate? In the parlor game of 3-ish up to Citigroup at 4-ish, and even our Adrian Wong of Bloomberg Economics up near 5%. Where does Bill Dudley's terminal rate rest?
It'd probably be like 4-ish. I mean, I think that's what's going to happen is that there's going to be a lot of ambiguity about whether the Fed has done enough. And as Paul made it clear in his press conference, the risk of doing too little are quite a bit greater than the risk of doing too much. And so the Federal Reserve is going to probably overdo it a little bit because they have to be sure that they're going to be successful in getting inflation back down to 2%. So I think that what will happen is they'll stay, they'll just keep tightening for a bit longer. They'll get to a higher terminal rate. One thing I would maybe disagree with a little bit with Chair Powell is he's pretty confident that they're at neutral today. I think there's a lot more uncertainty about what the neutral federal funds rate is. As he himself has noted, the federal funds rate passes through financial conditions, and there's a lot of variability between the federal funds rate and the impact on financial conditions. So to say that the Federal Reserve has arrived at neutral already, I'd be a little bit more skeptical about that.
It's not gospel just because they say it. Bill, you're dead on. You're right. And you introduced financial markets too. Bill, you're not at the Fed anymore, so you can tell us what you really think about what's happening in financial markets. Equities bottomed the day after the last Fed meeting. Yields topped the day before it. What do you make of the easing of financial conditions, and how do you think they're going to respond to it?
Well, I think the important thing here to recognize is the Fed wants financial conditions to be tighter because they want to slow down the economy to generate more slack in the labor market. That's what Paul said today. So, any significant easing in financial market conditions is incompatible with what the Federal Reserve wants to achieve. So, if financial conditions ease, then the Fed, all that means is the Federal Reserve is going to have to tighten monetary policy by more to get financial conditions back to where they need to be. So, I think that the upside for the markets are very much capped by the fact that the Federal Reserve needs tighter financial conditions to generate the slack in the labor market that we don't have today.
So, Bill, out of interest, what would you characterize as a significant easing of financial conditions? Is it the 100 basis point of tightening we've had back into high yield spreads? Is it the rally we've seen in the equity markets so far? Is it more? Is it less?
Well, I mean, I still think financial conditions have tightened quite a bit over the last 6 months. But if the markets were to, say the equity market were to rally another 5 to 10% from here, I would view that as sort of undermining what the Federal Reserve is trying to accomplish.
Wait, Bill, I want to just emphasize that. I was stuck on that. 5 to 10% rally in the stock market, and the Fed's going to come out and perhaps talk it down. What about in the bond market? Because what we've seen is a complete rally, particularly on the short end of the yield curve. Are they going to try to talk this back too and say, guys, you've got this all wrong. We're going a lot further than you seem to be thinking?
Well, I think the Fed doesn't want to, provide a lot of forward guidance about what's going to happen longer term because they just don't know because the economic outlook is so uncertain as you get beyond six months or so. And Powell actually talked about that at the press conference that, the uncertainty, the market has this very strong view that the Federal Reserve is going to stop, tightening, sort of at the end of the year, and then they're going to start easing in 2023. And I think Powell was basically trying to pour some cold water on that idea. We just don't know at this point.